There's a clear trend in clean, renewable energy, and today we're going to talk about one stock that's at the forefront of that trend. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And today we're going to cover the company AES Corporation, which is leading the charge in clean, renewable energy. Now, it's a value stock, and we're going to utilize the FastGraphs Fundamentals Analyzer software tool to help us determine whether this is actually an investment that we should actually consider making. And I'm going to posit that the company is actually very interesting if you're looking for total return or capital gain over the, say, next couple of years, or whether you're interested in income or both. So let's go ahead and turn to the FastGraphs Fundamentals Analyzer software tool to do that. But before I do want to make a few comments about value investing. Value investing is all about investing in good businesses when you can buy them below their true worth or intrinsic value. The idea is that you want to generate natural leverage by buying low so you can sell high in the future. When you can find a company that's undervalued, you have a built-in margin of safety as well as a long-term opportunity to generate above-average returns at below-average risk. And that's what value investing is all about. So let's go ahead and get into FastGraphs and let's look at AES and let's use the FastGraphs Fundamentals Analyzer software tool to help us determine whether we should be making an investment or considering an investment in this company now or not. So here we have a FastGraph at the maximum time frame going all the way back to 2004. And what this is adjusted operating earnings, non-GAAP earnings. I want to be clear about that. These are operating earnings. We like operating earnings because they kind of reflect clearly how the business is doing as an operating entity rather than considering a lot of accounting convention like non-cash charges, one-time charges, etc. So let's kind of look at AES without anything on the graph except their profits. This is a picture of the company, AES the company, and its history spanning about 2 decades. What we see here in 2004, 2005, and all the way through 2006, we see a company that was growing very fast. Earnings growth was 48%, 23%, and 25%. And then we saw all of a sudden a drop in earnings of 14%. And then we entered the recession of 08 and 09. And we did see a little bit of a nice 1% recovery in 08, followed by a 9% in 09. But then we had a drop in earnings again. Now, as I look at this stock, I want you to see what I see, if you will. I want you to see the attributes. I see high growth here. I see very flat growth through this maybe almost a decade here. And then I see starting in 2016, I see a period of very consistent, nice growth. And just by glancing at the bottom of the graph here, I can see it's been double-digit growth, maybe 8, 9, 10% growth. Now, the beauty of FastGraphs, it's a dynamic tool. This long-term growth rate, and considering all these machinations in earnings achievements, averaged about 6.5%. That's the earnings going from 74 cents to the estimate of 213 for 2026. But I can use the scroll feature of FastGraphs here, for example, and I can grab the scroll bar, and I can go all the way back to this growth period here, and here we saw the company growing at 31%. Now, if I put weekly closing stock prices, I see that stock prices kind of mirrored that growth. They had high PE ratios, and it mirrored that growth. But then as I pull this scroll bar out, and I see that we came into the period of falling earnings and then flat earnings, I see that the stock got overvalued and excited for the growth that we saw in those first 3 years. But then it was vulnerable, so once growth disappeared, the stock price fell precipitously going into the Great Recession. But then coming from the Great Recession, where it bottomed out at a PE of about 5, it very quickly rallied back to a PE of, we'll call it 14, or really approaching fair value again. And that would have been a tremendous time to buy the stock. You'd have more than tripled your money had you bought it during that time frame. All right, so that, buying low to sell higher was great. But then we had another bad year of earnings, and once again, we see the stock fall. The point of the story is that stock prices relate to the fundamentals of the company. And I'm going to argue that the fundamentals of the company are actually a lot more important than the short-term variations in stock price. So from here back, we see a company that was kind of really spotty. It was growing fast and it was dropping earnings, and then we had this hump in earnings. Again, as we come into this green energy revolution, and what the company's been doing recently is they've really been getting their act together, so to speak, on an operating basis, and they've been steadily growing earnings at about an 8% rate here. By the way, if I just take out this 1 year, actually 2 years here, we'll see that the growth rate was actually 8.48%. But again, that's about what the company's guiding for going forward, which we'll talk about here a little bit later in the future. So let's look at the max again. Now, we've got two parts of the graph. We've got the earnings and we've got the price and how the price relates to that. But this now is a company that's trading at a PE ratio of 9, has a great earnings yield of 11%, which is the inverse of the PE ratio, and a dividend yield of 4.27% as of yesterday's close. So we've got an over 4% dividend yield and a very low valuation, and we've got a stock that's beginning to right the ship and stabilize, but we've got a very inexpensive valuation. Let me talk to you a little bit about value investing and why value investing is so important. The whole idea here, as I mentioned so many times, is you want to buy low and sell high. The other idea is you want to make the much money as you possibly can, taking the least risk you can. And when you can buy a stock for less than its intrinsic value, you are actually building in a margin of safety. And then you are positioning yourself to not only participate fully in what the business offers you, but you actually will participate at a greater extent because you're going to get the opportunity to participate in all the growth, plus get some price earnings ratio expansion, plus collect any dividends along the way. It does take some patience. Value investing is not about market timing. It's about buying a good business at a very attractive valuation and then holding it for the long run. And that long run holding period is very critical. And I want to be clear, when I'm looking at an investment like this, I am thinking about owning it permanently. It would be my best option, but at least for 3 to 5 years. So let's go ahead and go back into the fast graph tool. All right, so now I want to bring dividends into the equation. So I'm going to click down here in this legend, the dividends and the payout ratio. All right, and I'm going to expand this a little bit so we can see some things. And one of the beauties of fast graphs, I see that AES started paying their first dividend in 2012. And I see that they started out paying 4 cents, and their payout ratio was only 3.2%. You can see that graphically on fast graphs. Then they increased the payout ratio to 12% and the dividend from 4 cents to 16 cents. And then they increased the payout ratio again to about 15% and grew the dividend from 16 cents to 20 cents. Okay, but then they grew the dividend, they doubled the dividend from 2014 to 15, and we now see a payout ratio of around 30 to 45%. You can see the payout ratio, 44.9, 44.4, moving ahead, 37.7. Analysts estimate that the payout ratio is going to remain around 40% going forward. Now, this area called the payout ratio down here at the bottom, I'm going to shorten this again so it's a little more clear. You see, this area is what they paid out in dividends. So I can take this area and stack it on top of the orange line, because what that does is show that I've got capital growth, from the price going from point A to point B, but then I also get the dividend income, and then I've got the PE ratio expansion I talk about. Now, the beauty is the stock was undervalued back in 2017 at a PE ratio of 12. The stock is even more undervalued today with a PE ratio of only 9. But even though it's done that, I've got 8% growth here. If I what the performance has been over this time frame, it's still been 7.88% or almost 8%, which mirrors the growth of the business. But again, a lot of that came from the dividend. Okay, I want to make that clear. The growth component was only 4.5%. The rest was made up by the dividend. That's one of the beauties of owning and investing in a dividend stock. But what I want to talk about now is the idea of where this stock could go. Now, there's another line we typically put on a fast graph. It's called the normal PE. This is the market PE line, how the market normally values a stock. And in this case, we've got a normal PE of 13.57. Okay, so that's what the market has normally been trading this stock at. So we'll say between 13 and 15 is fair value. We could call that a fair value corridor, but we could also up that to about 16 times earnings and call that. Now you could do that. You could go into the settings bar here and put in a custom valuation ratio. I could add a 16 PE ratio here to the graph. This is a tool that allows you to evaluate things. So now if I look at the new fast graph, I've got this corridor evaluation here, if you will, and I could have even maybe made that 17, but I can see where the stock, I can start doing some what ifs. So if I buy the stock today and the stock goes to its normal PE ratio in 2 years, then I could stand to make 40% a year. I could take $10,000, turn it into $17,000 in growth, add another $777 in dividends, and have almost double my money. Now, if I would have this go to its fair value PE, I would clearly double my money in that year's time frame. I would turn $10,000 into $19,000, get the same $777 in dividends, and that would average a 47.3% annualized rate of return. And of course, if I went to this higher PE ratio, then I could get 52.41 and more than double my money. My point is, you can quickly and easily run these calculations. You don't just invest in a stock and hope you can make some money. You have a clear idea of what your performance could be given various valuation references. Now I'm going to go ahead and get that PE ratio that I added off of the graph here just for simplicity's sake. So now I'm looking at this stock now, but let's talk about some other issues here. For one thing, the company, as I said, is trading at 9 times earnings with a 4% yield. It's triple B minus rated, which is investment grade, and one spot below it gets into the speculative grade. And I'm going to invite Professor Mauck to come in here and talk about the company's debt, because that should be the elephant in the room here. This company has 73.8% debt. And I'm going to have Professor Mauck kind of go through the financials and talk about the seriousness of that debt and what it means. But I also want to talk about why the company has that debt. So their market value is just over $11 billion. Their total enterprise value is about $41 billion because they carry so much debt. And I'll let Professor Mauck deal with that. But let's talk about some other issues here on using fast graphs to determine whether or not this is a good stock to own. Let's go into GAAP earnings or diluted earnings. Now here we see a entirely different picture of the company, because obviously the company is making acquisitions, and Dr. Mauck will talk about that. They're also investing heavily. Their capital expenditures are very high. They're planning on generating more power. We'll talk about that a little later in the video, and having it available to sell. They're focusing on green energy. So they've got depreciation schedules here, non-recurring charges, etc., that kind of muck up the earnings picture. But since this is a dividend paying stock, let's then go into cash flows. From an operating cash flow point of view, the company is more than adequately covering their dividends. So let's take the normal PE and the price off the graph, and I see we have operating cash flow let's do last year, $4.26, covering a 66-cent dividend. So they're only paying out 15% of their cash flow. However, because they are doing a lot of capital expenditures, if I look at free cash flow, they don't really have negative free cash flow for the last couple of years, although that is expected to improve going forward here. So that's a little bit troublesome. I like to see free cash flow covering the dividend as well. Now, earnings before interest, taxes, depreciation, and amortization, a.k.a. EBITDA, has been very slow growing. It hasn't really grown very much. If I take it back where I get past the estimates here, it's actually been negative EBITDA growth. And you could say similarly for EBIT, earnings before interest and taxes, it's been slightly negative growth. So, that's something else that I want you to understand. This is not a high growth stock. This is a valuation play. And sales for this company have been relatively low or flat as well. More recently, they've been increasing a little bit, but, it's not a great growth story. It's really a valuation play, and I want to reemphasize that and make that clear to everybody. This is all about buying a company that's trading at a valuation significantly below its intrinsic value based on earnings. Okay, and that's where the opportunity is. So let's go ahead and turn this over to Professor Mauck now, and let's talk a little bit about this massive amount of debt they have, but he's also going to point out that this company does offer some other intriguing investment opportunities through a joint venture they have with Siemens and some other things. So I'll let Professor Mauck take it from here. Nathan?
We're going to take a look at AES debt, and thinking about debt is obviously it's a risk to the firm that they can't meet their debt obligations. But before I get too in depth on a debt analysis with a firm, I just kind of like to scan a few things just to see just how serious to take it. Obviously debt always serious, but I like to do a quick scan. And so let's take a look at fast graphs for AES and see where it falls. So a couple of just quick things that I want to scan. One is the credit rating. So the S&P credit rating is a BB minus. That's on the edge of investment grade. That is still, I think, by most standards within investment grade, but kind of close to speculative grade. Just to kind of give you some idea, this is a report from late September the S&P did. And what you see is for speculative grade debt, actual default rates is kind of this gold line, and this goes back to the 80s. So, sometimes it spikes over 10%. We're kind of in the 4% range right about now. But just to kind of translate that rating into, historically, what has that meant for percent default rate on that? That's kind of what we're looking at. And again, AES a little bit better than that speculative grade. But that would be one of the first things I'd look at, and that would tell me that I want to take debt for AES pretty seriously. So it doesn't have a super high credit rating. Also, it has a lot of debt. First of all, we look at debt to total capital of 73%. That means of the total capital they have raised, obviously 73% of that's in debt. You can kind of see that when you compare the market cap of around 11 billion to the enterprise value of 41 billion. There's a lot of debt there. Another place we can see this is if we go to the financial statements and go to the balance sheet at a fiscal year end of 12/23 most recently. But if we scroll down to the liabilities section and look at long-term debt, you can see 22 billion, 21 billion, 17 billion. These are big numbers, especially again for a firm with a market cap like they have. Also, I like to take a look at debt compared to cash. So they do have quite a bit of cash and short-term investments on hand of 2 billion. But still, even when you net that out of the debt is still a big number. So understanding the debt for this firm, I think, is important, and an important part of the analysis. I might also say using a lot of debt for firms that serve the markets that AES serves is not unusual. Part of it is they can access debt because they tend to be buying physical assets. So their capital expenditures are pretty high and they engage in some acquisition activity. But a lot of times the assets they're buying are the types of assets that you can finance with debt. So not unusual, but still a large number and something to make sure you have some understanding of. If we take a look at the cash flow statement, first of all, you can see they start with a negative net income. You'll notice they have positive EPS. That is related to non-recurring items. So once you adjust for non-recurring, that net income would move positive. But they have pretty consistently strong and healthy operating cash flows. So about 3 billion in 2023. So they are certainly generating positive cash flows. But look at this CapEx number, 7 billion in 23, 4 billion in 22. Those are big numbers. And that is driving a lot of the debt that the firm is using. They're financing the CapEx spending with debt. And finally, I want to take a look at the income statement just to get an idea of the interest expense. So, just in interest, they're paying almost 2 billion, about 1.8 billion for fiscal year 2023. So taken together, their need to pay debt is strong because of the amount of debt they have. They have the need to issue new debt pretty regularly because that's largely how they're growing, is through CapEx and through acquisition. And so they'll probably have an ongoing need for new debt, assuming they continue to grow. One other thing that I want to mention is they do have a variety of subsidiaries, and one joint venture in particular I want to talk about is Fluence Energy, which has been a publicly traded company since October of 21. Fluence is a joint venture between Siemens and AES. That means that if you decide to make a play on AES, you're also making a play on some of their other holdings. And so from AES's 10K, this lists some of the entities in which they have equity ownership. And so you see Fluence, this publicly traded, the carrying value is listed at 148 million, but that's a 29% economic interest in the firm. So of another publicly traded company, Fluence, AES has a 29% economic interest in that firm. So that is a part of the analysis for AES as well.
All right, Nathan, thanks for that. That was very important to note the amount of debt this company has, but also important to note that this is not unusual for a company like this that's developing all this infrastructure and doing all those capital expenditures. So that's something to consider, but yet it is an issue, and it does something that you should consider very strongly when looking at a stock like this. All right, what I'd like to do now is move on back into fast graphs, if you will, and let's go into the forecasting calculators and talk about what the future holds for this company. Analysts are estimating 8.24% growth for 2024, and I want you to notice that's been very consistent. They've consistently held the $1.91 for this year. They estimate $2.10 next year, and they've held it pretty consistent. This is about as far as I'd like to go out, but there are 4 analysts who are saying we're looking for a rather anemic growth in 2026, and that'll still be to be determined. Because if I go to the analyst scorecard and look at how accurate analysts have been on a 1-year forecast, they've met estimates 92% of the time. They've only missed 8% of the time. And with a 20% margin of error, they've only missed estimates 8% of the time on a 2-year forecast. So by looking out to these next 2 years here, I have a pretty comfortable feeling that these estimates might be attainable. The long-term growth estimate for the company is about 8%. And that kind of becomes important. So, looking to the future, we've done a lot of work on the past here, but looking to the future, the company does look extremely undervalued. Now, the beauty of fast graphs, again, I want to really emphasize this. I don't buy a stock and hope I make money. I can calculate if it trades at 15 times earnings, that would be my annualized rate of return. If it traded at a higher multiple, like I showed you earlier, what was trading at 20 times earnings, so here we'll hit 21 times earnings, then, I can make 76% a year, almost triple my money. And if it traded at its, lower PE of something like 10 or 12 or close to where it's trading at today, even the 9 PE that it's trading at today, I could still make 12.86%. So I've got a pretty good risk-reward ratio. And again, a company where the analysts have been pretty accurate making those estimates going forward. So let's move on with fast graphs. Let's go into external links, and let's go into the company's corporate website. I always suggest that you do that when you're conducting your research and due diligence, because you can learn a great deal about the company you're considering by going on their website, looking at all their businesses and so on. But then you can also go into investor services, and you can look for financial presentations and webcasts. Now, I've keyed up their most recent financial presentation, which was done on February 27th of this year, okay? And, they're talking about the fact that in 2023, they just reported earnings, as I mentioned. In 2023, they exceeded all their strategic and financial objectives. They're increasing their gigawatts of renewable energy under preferred power contracts, PPAs they call them. And they also expect that to increase again. They added 5.6 gigawatts in 2023. They completed 3.4 gigawatts of construction. That was their objective. They actually did 3.5. And you can see they've exceeded earnings. The high side of earnings was $1.75. They exceeded that by $1.76. So, the company's raising their long-term growth rate targets. And these are all things that the company's giving you guidance and showing you where they expect their growth even to come from. And those are very important things to look at and consider when you're looking at investing in a company. So let's kind of recap. The company is very undervalued with a low PE. If we get PE ratio expansion up to 15 times earnings and get the 8 or 9% earnings growth achievements that the company is expecting, the rate of return for the next couple of years could be extraordinary. It doesn't come without risk. We've got the high levels of debt that Professor Mauck illustrated, and I've pointed out to you as well. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. I hope you enjoyed this video, and if you did, give me a like and subscribe to the channel. But also take a look at subscribing to FastGraphs. This tool is so powerful, and it can help you really analyze and evaluate a company. We call it a tool to think with. I can't imagine investing in stocks without fast graphs. Thanks again. Give me a like, subscribe to the channel, and subscribe to Fast Graphs. You'll be glad you did. Thanks for watching.